Good morning, everyone. I'm Vince Lancy. It's 7:45 Monday morning. This is the Gold Fix Market Rundown. Today, gold still isn't money. We're going to review some analysis by World Gold Council, which was quite interesting, very supportive of the gold market. And we'll talk about precious metals, specifically PGMs and silver today, in context of the market behavior. And we're going to touch on silver specifically. There's the home page. Uh, every story there has a story behind it. Lower right-hand side is one that we enjoyed very much, written by Jim Rickards, Why Fort Knox Gold Won't Be Counted. And, well, it reminded us of what we had said in November of last year. Then James spells out the leasing process, what's going on. And it's just amazing that nobody listens to this except for people like ourselves and you. We like that a lot. Top right-hand side, debt trap, why the 100-year bond idea will not work. That's a CIO of a firm that actually was floating the idea or listening to someone float the idea of the 100-year bond. And we throw a couple comments in there saying it's just complete nonsense. It will never work. Lower left-hand side, silver breaks 35 up 8.5%. We've had several posts on silver. And we until this morning, we had a position on silver. So we're going to go through that a little bit as well. That's a popular post. And in the middle, Michael Hartnett, in his weekly report, asks a question at the end of his analysis. And he asks, what will AI do to bonds? So he's looking at things from a bond lens. More specifically, if you want to look at it less from a market and more from an economy, what will AI do to the economy? Unemployment would be one way to look at it. AI should get people fired. As productivity goes up, people get fired. Uh, the flip side is, well, AI will make productivity go up and it'll be good for the economy net net. And he looks at those two questions as to which would win out. And we have our own specific particular answer, and it's really a third choice. And the third choice is based on what happened during COVID and what happened during the 70s. And that is they will throttle AI rollout to make sure unemployment doesn't spike too much. Anyway, we feel pretty strongly about that, and we offer some insights into why that's true. So you can watch that if you're interested in the macroeconomic aspect. And top left-hand side, special Basel III still doesn't recognize gold as money. That's what we're going to discuss today. And before we do that, let's start with the markets. Top right-hand side, silver, top left-hand side, platinum, lower left-hand side, palladium, and lower right-hand side is the gold-silver ratio, washing out to a normal range now, you could say. All right, 10-year yields are unchanged. The dollar is down 18. The S&P 500 is up 5, 6 handles. The VIX is slightly higher despite the market being strong. That's also consistent with calls being bid now. That's another conversation. Gold is 33.20, up about 9 and change. Silver is up 33 cents, testing the highs of Friday at 36.30. Copper is being dragged higher, pretty strong, up 4 cents. WTI up 10 cents. Natural gas down 4 cents. Platinum and palladium are very strong, both up approximately 3% on average. 1075 in palladium, 1204 in platinum, and gold silver is weaker yet again. Grains you can see are mixed there. And China is up another percentage point. Okay, so let's go to the story. We're going to talk about silver, and we're going to talk about platinum. We're going to talk about the gold silver ratio after we do the story. Gold isn't money. Gold is tier one capital, as many now know, but many do not know that gold, despite this new designation and rollout July 1st of it being official, so to speak, is still not considered money for liquidity purposes. This misplaced, we would call it ridiculous designation, persists despite recent evidence to the contrary. In our weekend post special, Basel III still doesn't recognize gold as money. We note that during the three most recent periods of extreme market volatility, gold traded one, the same or more volume as 10-year treasuries, two, at lower volatility than US treasuries, and three, with narrower, more consistent bid-ask spreads than bonds. Yet, according to Basel III, the World Gold Council notes, liquidity coverage ratio, LCR, gold is still excluded from EU bank liquidity buffers, while US treasuries remain more trustworthy for liquidity. Therefore undermining gold's status as tier one capital. We explore why this is happening and why it is not justified. Now, the World Gold Council compares it to US treasuries. And let's go through those three events that they note. In February of 2025, Trump's 25% tariffs on steel and aluminum prompted sharp treasury sell-offs. Gold remained steady. In April of 2025, Liberation Day, a sweeping tariff escalation triggered widespread bond volatility. Gold went up. In late April, a partial de-escalation led to market relief and a dip in gold. Fine. Still, gold's volatility remained inside treasury ranges. The exclusion of gold from Basel III's liquidity framework is difficult to justify to those familiar with the EU banking situation in general and the LBMA franchise specifically. Suffice to say, EU banks are not solvent, we believe, from an NSFR perspective. Otherwise, Basel III would not have been kicked down the road another year, which it just was. We have that story. And the LBMA body, regulatory body, has defaulted on its oversight obligations to keep an orderly spot market in the local London gold bullion market, making the whole West more vulnerable to financial catastrophe. Against this backdrop, we say from a regulatory perspective, gold may not be an HQLA, high quality liquid asset by their measures. From a market perspective, however, it already is, and we intend to explore this more in coming days. The full analysis, our breakdown of the World Gold Council's analysis is at that link there. We think it's very important. And there's a story within the story, which we covered for founders there. But just to give you the weight of the problem in Europe, or how bad it can get, or how much worse it can get, we want to tell you something that happened during 2011. We start with gold, Greece, and the Euro crisis in 2011. To give you an idea of how bad the banking situation is in Europe, contextually. In 2011, the gold market, 2011, 2012, got almost as high as 2000. And that was a very heady moment for gold people. But it was way worse in Europe. You remember silver also had its day in the sun then too. This is, during that same time, Greek bonds. Greek bonds during the Grexit period yielded as high as 30%, briefly, but it was there. How bad was the banking situation in Europe during this time frame? It was so bad that people in Greece were demanding euros that were printed from the German Bundesbank. They were rejecting euros printed in other nations, specifically their own. The banks in Europe were insolvent and not trusting each other. Greek bonds were yielding as high as 30%. Gold was on its way to 2000. And this was all because the euro, in our opinion, had no fiscal unity to back up its monetary pretense. And in the end, the government, this is about gold, the European supranational government organizations, the ECB and what have you, said, we will guarantee Greek bonds at par and we will buy them all from everyone. So everyone who had Greek bonds that was looking to sell them to get euros printed in Germany uh, relaxed a little bit. And the Greek bonds slowly came back and the euro was saved. But nothing really has changed since then. So if there's another crisis in Europe, it will be because they really haven't fixed what's going on in the banking sector. And you can see that. You had Europe's biggest bank absorb its second biggest bank, and the euro has really never recovered. I guess what I'm saying is, with regards to gold, gold, bringing this back to gold, gold is not money for them in Europe officially, because if it were, it would also be in the NSFR, which is their liquidity requirements, and it would show that the banking system is solvent. European banks are not solvent. If they were, they wouldn't kick this down the road anymore. Europe is a disaster waiting to happen, unfortunately. Much of the world is a disaster waiting to happen. Just Europe is an experiment that's about to fragment, possibly. A little bit of a doomer statement there, but that's what I think. Related posts, we mentioned those up top. Silver is where gold was 16 months ago. That's an interview that Jordan, Roy Byrne, and I did, and we believe that silver is where gold was 16 months ago, provided the market settles above 36 on June 30th. Data on deck, it's a big week on deck. CPI and PPI, I think the markets are all leaning towards, specifically equities and bonds, are leaning towards CPI and PPI to keep trending lower. And as a result of that, the markets are wanting to go higher. You can see that in stocks right now as well. The market is sanguine about its feelings on inflation right now. They're looking more at recession than inflation. And, for good reason. Let's get to the charts, right? A little bit of chart magic here. Okay. I want to start with gold and silver, gold, silver. Uh, this line, these channels were drawn years ago. Okay. And it's amazing that the channel on the right is working. The channel on the left it happened to me, and I just got killed on silver on that. But the channel on the right, this is a whole pattern of gold being remonetized and silver not be, and it gets overbought and it gets underbought. But it's pretty quick how we traverse that channel. I wonder, and I've said this before, and I've had conversations with Michael Oliver about this. I wonder if this channel is still valid. It's obviously valid, right? But if we get, now that we've broken back into here, or we're on the edge of breaking back into there, if we start to kick back down to here again. So now maybe this channel will start to matter. Anyway, I think that's significant from a gold and silver perspective. Now, from a purely silver perspective, let's go to the daily. And I'm going to pull up Bollinger Bands. Those of you who are on the Goldfix chat, and we were talking about the silver signals that I got, and I got long. I want you to know that as of right now, I'm out of the trade. And it doesn't mean I'm bearish. It means my signal is done. Okay, so the signal went like this. Buy it Stay long, stay long, stay long, stay long. Right here, I took two-thirds off. And here's the final third being taken off right now, or about a half hour ago. So, or hedged. That part is still on. It's just hedged. Uh, Essentially, if you're a follower of this, it's a volatility-based system. This is the market coming out of the gate and impulsively rallying. Okay. These signals last anywhere from 3 to 5 days when they're good. Can they be negated after 3 to 5 days? Yes. Can they continue? Yes. But it's not that signal. That signal says out of the gate, the horse is leading on the gate opens, and you can see silver's just going to gallop to the lead. And it does. And in this situation. And after it's done that, then the race is really on. So now we're going to see what the market does on its own merits besides the impulsive out of the gate moment, out of the blocks, if you want to look at it as a sprinter. And this market could have another 2, 3 days sideways and then go a lot higher again. I'm not predicting that. I'm just saying the pure reason to buy this out of the gate is no longer there. Of course, the reason to stay long is extremely there, and it's probably smart to stay long as the market doesn't break. So for today, if the market doesn't break 35.50, you're long. Tomorrow, probably 35.70. These are short-term comments. These are not long-term comments. Long-term, I bring you back to what my conversation with Jordan. The market settles above 36 on June 30th. All kinds of money is going to come into this market, all kinds. And I'm starting to wonder if the bullion banks are about to get their asses handed to them in silver now. Uh, that's it. Platinum, right? I should talk about platinum for a second. Platinum is like silver. You got to buy signal. I didn't buy it. You got to pull back. You would have gotten out on your pullback here, and now the market's kicking again. You know, I'm starting to feel that if gold was the point of the spear on the global reset, the first thing to go is gold. And then copper is its own animal. The other metals might start to catch up, not just on a daily or weekly basis, as we're seeing in the gold silver ratio, but maybe on a more fundamental basis. You know, if gold stays at $3,000 long enough, doesn't every other commodity in the world have to rise a little bit on their own merits? And I think metals are the easiest ones to look at. Uh, the PGMs are a good example. I mean, they're tied to gold indirectly in terms of the mining industry. And I happen to know that the banks were short silver against being long gold. The banks were short platinum against being long gold. The banks have been covering the banks were short silver against being long copper. And now they've all covered. The question is, and I'm looking at the Goldman Sachs's here. Do they see something we don't? And are they now getting long against it? Or do they think this is just another cycle of trading? We'll see. Have a great day.